So see now, the company we've selected to model is TVS Motors. What is the plan of action that we are going to follow after this? Step number one for us, that is the agenda for next 2 to 3 weeks, is just to read annual report carefully. Okay. So if you want to analyze some company, it is very essential that you understand that business in depth. Okay, so you need to know every nitty-gritty of that business, everything that concerns the business should be aware of. So we would spend a lot of time and we would try to read annual report. I generally like to go old school on this. So I would prefer to get that annual report printed. And what I used to do earlier, whatever companies I have modeled in the past, take a printout of the entire annual report, carry it with you wherever you go. Okay, but try to read and learn as much as possible, because the more you learn, the better is going to be the quality of assumptions. Okay, so that's step number one. Once we are completely comfortable with all the numbers and data available, then step number two for us is that we will start building an infrastructure. Okay, so what we'll do in this step, we will take all the data from the balance sheet, income statement and cash flow, even from the schedules, and slowly start putting that data into Microsoft Excel, and then we will rearrange the whole set of data so that it becomes analyst friendly. Okay, so you rearrange that data in such a way that it becomes easy to model that data. In step number 3, we will start all the forecasting activity. Okay, so this is where we will forecast revenue, we will forecast all the cost, we will forecast working capital, forecast debt, forecast assets, and then once all of this done, then we will have income statement, balance sheet and cash flows. These income statement, balance sheet and cash flows we will integrate with each other, so that if you change one small number in your revenue sheet, the entire data will flow automatically. And once this part is done, once you forecasted data for 5 years, then our last step is going to be valuation, where we will use a different valuation technique and come up with a valuation for the number. Okay, so let's start with the annual report. I want you to open 2013 and 14 annual report, TVS Motors. Okay, so relatively smaller size annual report. Is it a good thing or not a good thing? Ideally you would want annual report to be small or big. Chota ho to jaldi khatam. So the intuition here is you would want company to give you as much information as possible. So if you would see annual report of maybe some other companies, Hero or most of the competitor, you will find 251, 300 page annual reports. Okay, so relatively smaller size. Let's start running through it. Board of Directors: Venu Srinivasan, Sudarshan Venu, Lakshmanan, Kannan, Dua, Bajpayee, Ramakrishnan, blah blah blah. We'll get acquainted with these names with time. Registered office is in Chennai, Tamil Nadu. Auditor: Shankar and Iyer Company, Mumbai. Share listed on Bombay Stock Exchange, National Stock Exchange. These are the content. Financial highlights, notice to shareholder, director reports to shareholder. So we'll try to go through all of these parts in step-by-step process. Let's look at the financial highlights of the company. See now, what happens to people is that they get too much into nitty-gritties of modeling. कि Excel का presentation ऐसा होना चाहिए, और top line should be here, color coding, यहाँ पे blue, यहाँ पे black. But what is more important is that you need to understand that business properly, and you need to learn to get a sense of the numbers. Okay, so for example, if you're modeling TVS Motors, and if suddenly says and someone comes to you and asks that what is the margin they have on geared vehicles, or what is the margin they have on non-geared vehicles, what are the margins they have in, let's say, African continent, or what are the margins they have in Indian. You should have an intuition of all these numbers. Okay, so try to build a larger intuition here. This is rupees and crores. 2004-2005, the size of the company is about 3,000 crores. 13 to 14, they've reached almost double or more than double in 10 years. So this is about 8,000 crores here. That's how the company has been growing. I think there was a big growth. Can you see this? 29, 33, 39, 33, 37. This year we have some growth of about 600-700 crores. However, from 4,500 it has jumped to 6,300 directly in one particular year. Right? So maybe we should investigate the reasons. So I want you to start making notes parallelly, and we will try to find out reasons behind every number there. So either you make it in Excel or you write it, whatever way you prefer. So note number 1, find out the one. Note number 1, reason for increase in revenue. Reason for increase in revenue in 2010-2011. Okay, and can we also calculate by how much it has increased? Yes, it was 6324, and the previous year 4485. So that's an increase of 41% in one single year. Okay, I'm sure no analyst would have ever predicted a sudden increase of growth of 41%, but if you find out the reason, we would have a better understanding कैसे क्यों हो रहा है. Let's go ahead. Profit before interest, tax, depreciation, amortization. What is this number? EBITDA. We generally call it EBITDA. Earning before interest, tax, depreciation, amortization. And this is nothing but cash operating profit. Okay. So 332, and here we have 532. So even though there is a very significant increase in revenue, the same increase in profit is not being reflected. Especially there is a decrease in margins. Okay, how do we know that there is a decrease in margin? Let's do some basic calculations. Let me copy paste these numbers. 2995 and 332. This is for 2000 and 2004 and 5. This year 2013-14, this number is 7922 and this is 532. So you can simply calculate their profit margin. Profit margin would be profits divided by the revenue number, and that happens to be, or that used to be 11.24, and now it is 6.66. So there is a significant decrease in EBITDA margins. Okay. Are we okay? Let's go ahead. Profit before tax 200, 168, then suddenly a very sharp decline of 91, a significant decline 35, 31, 76, then again an increase of 248. So which means there is a possibility of having some extraordinary items, isn't it? Because you can clearly see with a revenue of 3741, profit before after taxes 31. Now I don't know if you know this, but what companies generally do is, let's say I have a revenue of 3741, and there are multiple financial state iterations which are done. So I first prepare my financial statement, and it actually shows a loss of 60 crores. Okay. However, if I go onto the streets in the markets and I tell them that there was a loss of 60 crores, that's going to create a lot of negative sentiment about the company. So what companies rather would do is play around with numbers a little bit in such a way that instead of showing some amount of loss, you show a very small amount of profit. So you're still a profit making company, So with a little bit of manipulation, you turn yourself into green. Okay, so with these numbers, we need to be a bit careful. Okay, because the numbers are really, really small. So it is quite possible that those years company actually had losses and maybe they turned them into profits. So write down one more thing in your notes. Investigate the reason. Investigate the reason for low profit margins in 0809, 89 and 78, these 2 years. Going further, net fixed assets from 770, it is 1174. What conclusion can you draw from this? Yes, one conclusion maybe we can think is company has not invested maybe sufficiently into fixed assets, or what conclusion can we draw from this? Maybe company has become more efficient with its operation of assets. Okay, so we typically calculate a ratio. I'm just copy pasting these numbers. Net fixed assets. These are net fixed assets for all the years, not copy pasted properly. Two 2013-14, the size of fixed assets is 1174. Okay, so let's have that number here. And in 2004-5, it was 770. We also have revenue. This is sales and this is EBITDA. We can calculate a number called as fixed asset turnover ratio. How do we calculate that? Sales divided by fixed assets. So earlier that ratio was 3.83 and now the ratio is 6.80. What does it tell us? Increase, absolutely. Yes, they're more productive. Earlier the sales was only 3.83 times of whatever assets I had. However, in the latest year, the sales was increased to 7 times of the size of asset that I have. Right? So I want you to integrate everything that we've been learning so far. I'm assuming that you would know what is Dupont analysis. Right? So Dupont analysis gives us the reasons to investigate ROE of a firm. A 3-factor Dupont, which helps us that ROE is based on these parameters: net income divided by sales, sales divided by assets, and assets divided by equity. This is a leverage, financial leverage. This is asset turnover and this is net income margin. Right, so think from this perspective that we clearly saw net income margin was decreasing. Now, EBITDA margins decreased, which means net income margin decreased. But what we also see is that asset turnover has increased. So in a way, there are two opposite direction effects that's happening here for the time being. Let's go back to annual report. Share capital 24, 24, 24, 24, and then we have double the amount here. What is this? Increase fresh capital. Okay. And increase fresh capital is a possibility. What else? Bonus shares. That share capital is always calculated as face value into number of shares. So either it will increase if you issue new shares, or it will increase if you have bonus shares. So write down your next question. It's a very high possibility for bonus share because the number is exactly doubled. That means it could be 1:1 bonus share. But let's investigate. Find out the reason of increase of share capital in 2010-11. Are we okay? And of course, as we read annual report, we'll slowly start finding out pieces of information. Reserves and surplus 655, and it's increasing steadily. 700, 800, 900, 1100, and then 1300. Okay. How are these reserves increasing? How do they increase? Profit after tax and after distribution, which is being put back into the business. Net worth, I suspect it would be a total of these two. Just try. 48 plus 1368. Yes, it's total of equity share capital and the reserves and surplus. Total borrowings 527, 635, 831. So these are the numbers. Let's look at them carefully. 187, and then it increases to 300, then double next year 600, 900, 1000. Then they reduce some leverage here 700, and currently it's 527. What trend we can clearly observe is that in the last 3 years, company has been trying to get rid of the leverage, and this is important for us because we will be preparing a debt schedule where we would be trying to forecast what would be amount of debt next year, a year after that, and that time this trend needs to be kept in mind, that every year the amount of debt has been on the reducing trend. Earning per share 2.9, 5.51, so about 2 times. 2.9, 2.4, then again for these years it decreased, and then again on the upward trajectory. Last year a significantly lower number, and again back on track this year. Dividend per share 1.3, 0.85, 0.7, 0.7. Can you see in these years dividend is more than earnings? दिख रहा है ना यहाँ पे? Dividend paid is more than earnings. 4.1, 1.1, then 1.3, 1.2, 1.4. What kind of a policy you feel the company is following with dividends? Yes, it's a constant amount of dividend. So 1.3, 1.3, then the years when the company did not have sufficient profits, they reduced it. However, after that again they are more or less on the same trajectory, which means irrespective of how much profit I have, see here, irrespective of profitability, the amount of dividend is going to be more or less same. So again, important factor for forecasting future dividends. Book value per share 12.79, 29.50, increasing slowly. How is book value per share calculated? Total net worth divided by number of shares. EBITDA turnover in percentage. What is this? EBITDA divided by turnover in percentage is what? Cash operating margins. EBITDA is cash operating profit, so this is cash operating margin. So the number that we calculated is anyways available. हम लोगों ने किया था ना इसको calculate. See this. We calculated it to be 11.24, and this year 6.66. They have given us 11.2 and 6.7, same number. Profit before tax as a ratio to turnover. Return on capital employed, return on net worth. The figures from 2010-11 are based on revised Schedule 6 classification. Up to 9-10 are based on respective years reported results. So we saw that in the earlier companies as well, that 2010-11 onwards we had the revised schedule 6, which means the modeling period that we have 9 10 9 10 से शुरू किया ना हमने 9 10 10 11. So 9 10 annual report that we have taken, that would be from the old schedule 6. However, all reports after that would be revised schedule 6. Figures stated are before exceptional extraordinary items. Earning per share and book value per share for all the years have been calculated after considering bonus issue made in 2010 and 11.